In a move that might seem surprising to some, the European Central Bank, ECB, has decided to keep interest rates steady, despite the economic storm clouds gathering on the horizon. But here's the twist. This decision comes at a time when the global economy is grappling with the fallout from Trump's aggressive tariff policies. So what does this mean for Europe's financial future? Let's dive in. The ECB's rate-setting council, meeting in their iconic Frankfurt skyscraper, opted to maintain the benchmark deposit rate at 2%. This decision reflects a sense of cautious optimism, as the Eurozone economy has demonstrated resilience in the face of Trump's tariff onslaught. The Global Survey of Purchasing Managers, a key economic indicator, supports this view, showing a reading of 51 in August, which indicates continued expansion. And this is where it gets interesting. While the U.S. Federal Reserve has hinted at potential rate cuts, the ECB is holding firm. This divergence in monetary policy approaches raises questions about the future of global economic coordination. Could this be a sign of Europe's growing economic independence, or a risky move in an uncertain global landscape? The Eurozone's 0.1% growth in the second quarter, though modest, is a testament to its ability to weather the tariff-induced turbulence. Moreover, the EU's Executive Commission has negotiated a 15% ceiling on U.S. tariffs on European goods, providing some stability in an otherwise volatile trade environment. As ECB President Christine Lagarde noted, trade uncertainty has clearly diminished. However, the ECB's decision to maintain rates is not without its complexities. The bank's deposit rate plays a pivotal role in shaping borrowing costs across the economy. By keeping rates steady, the ECB is striking a delicate balance between controlling inflation and fostering growth. Higher rates can curb inflation but may stifle economic activity, while lower rates can stimulate growth but risk inflationary pressures. Here's the controversial part. The ECB's inaction on rates comes amid France's escalating fiscal crisis. With a divided parliament struggling to address a 5.8% GDP deficit, France's bond market borrowing costs are on the rise. While the ECB could theoretically intervene to stabilize the situation, this would only be possible if France adheres to EU debt rules, which it currently does not. This raises a critical question. Should the ECB prioritize financial stability over fiscal discipline, or risk market turmoil by taking a hard line? Lagarde, ever the diplomat, emphasized that the ECB's emergency bond market backstop was not discussed at the meeting. She assured that the European bond market is functioning normally, stating Euro area sovereign bonds are orderly and functioning smoothly with good liquidity. Yet, this begs the question, is the ECB doing enough to prepare for a potential market panic, or is it underestimating the risks? As analysts point out, Lagarde's challenge is to navigate this delicate balance without appearing to bail out fiscally irresponsible governments. But with the global economy at a crossroads, one can't help but wonder, is the ECB's steady hand on the tiller enough to steer Europe through the storms ahead? What do you think? Is the ECB making the right call, or should it be more proactive in addressing these challenges? Let's hear your thoughts in the comments.